Investing money is scary, but if you have a solid plan, know what you're doing, and are patient, you can create a bright future through investing and saving. However, it's important to remember that there are risks involved, especially when the stock market takes a dive. Market crashes can occur suddenly, usually when there's a big drop in stock prices. These crashes often come out of nowhere, especially after a long period of rising stock prices known as a bull market. One key sign of a stock market crash is when investors start to panic and sell their stocks quickly to either limit their losses or meet a margin call. Even though a stock market crash can happen fast, many of the most significant crashes have had lasting and serious effects. Here's a quick overview of some of the most famous stock market crashes. 1929 stock market crashes. The biggest stock market crash ever happened in 1929 and played a major role in starting the Great Depression. This crash suddenly ended a time called the Roaring Twenties, when the economy was growing fast and the stock market was thriving. The Dow Jones Industrial Average jumped from 63 points in August 1921 to 381 points by September 1929, which is a huge increase. However, it began to drop from its highest point on September 3rd, and then it really plummeted during a two-day crash on October 28, 1929. On Black Monday, the Dow fell nearly 13%, and it dropped almost another 12% on Black Tuesday. By mid-November 1929, the Dow had lost about half of its value. The stock market was in a bearish state, meaning it had decreased by more than 20%. The Dow kept losing value until the summer of 1932, when it hit a low of 41 points, which was a shocking 89% lower than its peak. It took until 1954 for the Dow to return to its pre-crash value. The main reason for the 1929 stock market crash was too much borrowing. Many individual investors and investment trusts started buying stocks on margin, meaning they only paid 10% of the stock's value upfront through a margin loan. Investment trusts also often bought shares of other highly leveraged trusts, which made their fates closely linked. Consumers were also buying more things on credit. When this debt bubble burst, it led to the worst stock market and economic crash in modern history. Kennedy Slide of 1962. The Kennedy Slide of 1962, also known as the Flash Crash of 1962, represents a significant yet often overlooked stock market downturn in American history. Occurring during John F. Kennedy's presidency, this market correction lasted from December 1961 to June 1962 and was the first major decline since the post-market World War II economic expansion. The U.S. stock market had experienced decades of stability and growth, particularly in the 1950s, characterized by strong industrial output and rising consumer demand, leading to a perception of the market as a safe investment environment. However, signs of overvaluation and speculative excess began to surface, with the S&P 500 increasing by over 240% from 1954 to 1961. The downturn initiated subtly in late 1961, but escalated sharply in the spring of 1962, culminating in a 22.5% drop in the S&P 500, which significantly undermined investor confidence. A notable event during this period was the Dow Jones Industrial Average's 5.7% decline on May 28, 1962, marking one of the largest single-day losses in its history. Several factors contributed to the crash, including growing concerns about U.S. economic policy and the Kennedy administration's approach towards large corporations, particularly in the steel sector. Additionally, geopolitical tensions from the Cold War, especially the lead-up to the Cuban Missile Crisis, added to market volatility. Investor psychology also played a crucial role, as years of consistent gains led to complacency among investors, who were unprepared for the abrupt downturn. Although the market stabilized later in 1962, the Kennedy Slide highlighted the inherent vulnerabilities of the stock market, even during periods of economic strength, driven by policy changes, geopolitical uncertainties, and speculative behavior. Black Monday Crash of 1987. On October 19, 1987, known as Black Monday, the global financial system experienced a historic market crash, with the Dow Jones Industrial Average plummeting by 508 points, or 22.6%, marking the largest one-day percentage loss in U.S. stock market history. The rapid decline triggered a worldwide market downturn, with significant losses in major international exchanges, including a 10% drop in London's FTSE 100. By the end of October, major U.S. indices, such as the S&P 500 and NASDAQ, had lost over 20% of their value, erasing trillions in market capitalization. The crash was perplexing to economists due to the lack of a singular cause, as there were no major geopolitical events or corporate failures to attribute the decline. Contributing factors included a widening U.S. trade deficit, inflation concerns, rising interest rates, and tensions in the Middle East affecting oil production. However, the most significant factor was the rise of program trading, where automated systems executed large sell orders in response to falling prices, creating a panic-driven sell-off that overwhelmed traditional market mechanisms. Despite the severity of the crash, the underlying economy remained robust, with healthy corporate profits and stable employment, allowing for a relatively quick recovery. By early 1988, the Dow had regained much of its losses, and by September 1989, it returned to pre-crash levels. The events of Black Monday prompted regulatory changes, including the introduction of circuit breakers to halt trading during extreme volatility, highlighting the dual nature of technology and amplifying market risks, while also improving efficiency. This incident fundamentally changed how markets prepare for and manage crises in the future. Dot-com bubble of 1999 to 2000. During the late 1990s, the United States experienced one of the most euphoric and ultimately devastating speculative episodes in financial history. The dot-com bubble, fueled by the explosive growth of the internet and the promise of a radically digitized future, investors began pouring unprecedented amounts of capital into internet-based startups, many of which had yet to generate revenue, let alone profits. The NASDAQ Composite Index, dominated by technology stocks, soared as a result, skyrocketing from around 1,000 points in 1995 to over 5,000 points by March 2000. This rapid surge was driven by intense market optimism, aggressive venture capital funding, and a collective belief that the internet would revolutionize every sector of the economy. At the heart of this surge was a wave of irrational exuberance, a term popularized by then Federal Reserve Chairman Alan Greenspan to describe the overheated and speculative nature of the market. Investors and analysts alike began to dismiss traditional financial metrics like earnings, revenue, and cash flow. Instead, they focused on the sheer potential and future market share of internet companies, many of which were still in the pre-revenue stage of development. As long as a company had .com in its name, it seemed destined for astronomical valuation, often regardless of whether it had a viable business model. Initial public offerings, IPOs of tech startups, became media events, with share prices sometimes doubling or tripling on the first day of trading. This fervor encouraged even more companies to go public, further inflating the bubble. However, the unsustainable nature of these valuations became increasingly apparent by early 2000. On March 10, 2000, the NASDAQ Composite Index peaked at 5,048.62 points. What followed was a swift and brutal correction. Over the next 2 years, the index plummeted nearly 77%, bottoming out at 1,139.90 points on October 4, 2002. Investors saw trillions of dollars in market value wiped out. Many high-flying startups went bankrupt almost overnight, and thousands of jobs were lost across the tech sector. Companies like Pets.com and eToys.com became symbols of the speculative excess that had gripped the market. The crash was triggered and exacerbated by several key factors. One of the major catalysts was the Federal Reserve's decision to raise interest rates in a bid to curb inflation and cool down the overheated economy. Tighter monetary policy made capital more expensive and less accessible, putting pressure on companies that relied heavily on continuous funding to survive. As liquidity dried up, confidence evaporated, and the selling began in earnest. Additionally, a slew of earnings reports revealed that many tech companies were burning through cash far faster than anticipated, undermining any justification for their sky-high valuations. The long-term impact of the dot-com crash was profound. The Nasdaq Composite Index would not return to its March 2000 peak for nearly 15 years, finally recovering in 2015. While the crash was painful, it also served to weed out unsustainable business models and helped lay the groundwork for the more disciplined and scalable tech giants that would emerge in its aftermath, such as Amazon, Google, and Apple. It also reshaped investor attitudes toward tech valuations and highlighted the critical importance of sustainable growth and sound fundamentals in financial markets. Financial crisis of 2008. In 1999, the Federal National Mortgage Association (FNMA), commonly known as Fannie Mae, aimed to enhance access to home loans for individuals with low credit scores and limited funds for down payments, which were typically required by lenders. These individuals, referred to as subprime borrowers, were provided with mortgages that included terms such as higher interest rates and adjustable payment schedules, reflecting their increased risk. The expanded availability of mortgage financing attracted both those who had previously been ineligible for loans and investors, leading to a significant surge in mortgage originations and home sales. Concurrently, many consumers, including numerous first-time homeowners, incurred additional debt to purchase various goods. Companies eager to take advantage of the booming economy also accumulated substantial debt. Financial institutions leveraged inexpensive debt to enhance the returns on their investments. The stock market, which had been buoyed by debt, began to exhibit signs of an impending downturn in March 2007, when the investment bank Bear Stearns was unable to manage its losses associated with subprime mortgages. Although Bear Stearns' collapse alone did not trigger an immediate market crash, evidenced by the market's rise to 14,164 points on October 9, 2007, by September 2008, the major stock indices had experienced a decline of nearly 20% in value. The Dow Jones Industrial Average did not reach its lowest point, which was 54% below its peak, until March 6, 2009. It subsequently took 4 years for the Dow to completely recover from this downturn. COVID-19 crashes. The latest stock market crash took place in 2020, as the COVID-19 pandemic spread across the globe. In the week of February 24th, the Dow Jones and S&P 500 experienced significant declines of 11% and 12% respectively, representing the largest weekly drops since the 2008 financial crisis. On March 12th, the Dow suffered a staggering one-day decline of 9.99%, the most substantial since 1987, followed by an even steeper fall of 12.9% on March 16th. In contrast to previous market downturns, which required years for recovery, the stock market rebounded swiftly, returning to its pre-pandemic levels by May 2020. This rapid recovery was largely driven by a substantial influx of stimulus funds, as the Federal Reserve reduced interest rates and injected $1.5 trillion into money markets, while Congress approved a $2.2 trillion aid package at the end of March. Here it is, some of the most shocking and money-losing stock market crashes ever. From the terrible crash of 1929 to the quick drop in 1987, the dot-com bubble bursting, and the market crash during COVID in 2020. These events have changed economies, taught investors to be careful, and shown us the importance of being strong in tough times. If you enjoyed this video, please give it a thumbs up, subscribe, and share your thoughts in the comments. We want to hear from you.